Good afternoon. It's really an honor to be here in Macau and share with all of you a topic that I'm very excited with, the rise of the operator-led growth. As an operator myself, I'm Brazilian, based in Shanghai, but I worked with the scaling of global brands in more than 30 countries. And now we have X Sigma Partners as an operating platform focused on scaling fitness brands and pet care brands. We started 2 years ago, we have currently 3 brands, My Bar, Aboro, and Wectopia. So learning from the successes and failures of several M&As and IPOs throughout these 15 years, I would like to focus on the alignment of 3 key incentives that are key for this model. So 1, the investors, 2, the founders and entrepreneurs, and 3, the management teams that actually join the companies to help this scaling process work. So I'm going to go back to these 3 in just a second, but let's take a minute. I want to ask you to use a little bit of your imagination. So let's imagine a world where there's geopolitical stability. I know it's a bit hard to imagine nowadays, but it's actually not that far back. Imagine a world where globalization is thriving and a world where the economic growth and very low interest rates. What's the combination of all these factors in this equation? Is a world with extremely high liquidity. What does extremely high liquidity mean? It's a lot of banks giving money to individuals, to companies, a lot of M&A activity, a lot of IPOs. There's a lot of money available in the market. So let's call these the golden ages, because as you know, this is not the scenario that's happening right now. In these golden ages, let's look at the typical growth cycle of a company. So you start focusing on your product, on your R&D, then you start to take off until you reach that growth stage. And the growth stage is where the magic happens, where the exits happen, and the liquidity window happens. In this traditional model, we're used to see the venture capital and private equity funds play a very big role. And how do they play this role typically? Looking at private equity, 2 big playbooks. 1, find new avenues of growth. So typically you would go through a new geography, or you would just find another vertical or product portfolio. But the most important playbook was financial engineering. So they call balance sheet optimization, right? So leverage buyouts, tax shield. Notice that I'm not talking much about operational. There was a lot of financial engineering that very quickly built a lot of value for a lot of companies. When we look at the VC funds, there's a lot of fragmentation. So I like to call this the spray and pray approach, where you invest in 100 companies hoping that one of them is going to hit a home run. And also, it's very targeted on a few specific industries. So you surf the hype of being on a hot topic. But in the end of the day, scaling businesses, and in the case of my presentation, it's focused on consumer and retail, not AI or biotech and these hot industries. You need to balance these 3 stakeholders that I mentioned in the beginning. So what are they looking for? So founders are looking for capital. They're looking for a support network that allows them to grow. And they're looking for the management team and talented people that are going to join them and help them grow the company. When you look at investors, they have their money parked elsewhere in assets that are not so risky. So when they come to play the private market, they want very high returns, above average returns. And they're looking for the exits so they can get their money back, right? How about management? What are they looking for? They're looking to work for an environment and a culture that rewards them. And most importantly, they're looking to get a piece of the pie and have ownership and shares. As they build growth of these assets, they can also enjoy that together with founders and investors. So this is the alignment of incentives of these 3 important stakeholders. So if we go back to the world that we just imagined together, the high liquidity world, how is that happening? Let's call this the golden ages, right? For entrepreneurs, it was great. You could raise money on a PPT. There were a lot of entrepreneurs that were pitch deck experts, spending not so much time on their company, but on crafting their pitch deck, but raising a lot of money. There were a lot of investors, a lot of angels, funds giving away money. They could also fail very quickly and just start again. So it was a very thriving community. Investors were also happy because there were a lot of exits happening, a lot of M&As and IPOs happening. And it was a very good asset class. So the exits happening allowed very good returns. And they were paying fees, right, to the funds. Typically, they would pay 2 to 2.5% a year based on the value of the fund. But they're okay, the exits were happening. For the management, it was focused on growth, all the excitement of growth, not so much focus on profitability. But it was okay, growing, stock options were getting valued. But there are current challenges, right? We know the world that we imagine is not the world of today. So for entrepreneurs, raising capital is harder. They spend a lot of time there. Investors are in a wait-and-see mode. How about the investors? They're also not happy with the scenario, right? These very uncertain exit, the return, they start to question the return risk portfolio here. And they're also not so happy paying the fee for the funds and having their capital locked there. And for the management, less excitement, focus on revenue, a lot of focus now on sustainable growth. Cash flow and EBITDA, more important than revenue. And those stock options, they're not sure if those stock options are going to be valued anything because there's not so much exits happening. So the operating model here is going to focus on sustainable growth, a lean structure, so you don't need to raise so much money. So that's smart fundraising, and level up your management capabilities from day one. How does that happen? So a team of experts in a certain industry are going to focus on the cycle, the complete cycle of identifying a concept, deploying capital from investors, but the most important part, actively managing the assets. Not on advisory basis, but actually running the day-to-day operations. In this model, you're going to focus on industries where this team has expertise. And in our case, health and fitness, pet care, and food and beverage. And why? Because all these three are high growth, especially in Asia and in China, where we're focused on, and extremely fragmented. So there are not many chains that took this market yet. So this is a snapshot. So we're talking about decades of experience of a team that has worked in flagship multinational companies and bring a lot of professional management for the company since day one. And how's that important for value creation? The founders, they can focus on the consumer and on the product instead of being distracted by the technology, the finance, the accounting, the fundraising, while there's a team of operating partners that are running that, and this combination of founders focus on the product and consumer with an operating partners team focus on building the management capabilities for scaling is a winning proposition. And how about investors? Investors come with us in the holding companies for each of these segments. And we're not structured as a fund, which gives us a lot of flexibility of how to build this portfolio and decide when we want to exit. Also, for an investor and founder standpoint, that helps increase the exit probabilities. Think with me for a second. If you are a fitness entrepreneur and you start a concept and you open 30 locations, well done, that's great. You have 30 fitness studios. But guess what? That's not really enough for you to scale and have a private equity fund come and buy you out. But if you put 3 or 4 brands or 5 brands under the same roof, it's much faster to get to 100, and it's much more likely for you to have an exit. So this operating platform addresses these 3 concerns when the entrepreneurs don't waste much time on where they're not very good at and where it doesn't add much value to the product. The investors don't need to pay fees. There's a perfect alignment of incentives where the entrepreneurs, investors, and management, they all have skin in the game in the same entity. And the management is lean, is focused on EBITDA from the beginning, on profitability. And everyone involved shares this ownership and wealth creation process. So as you see, it's all about the alignment of incentives. The world today is not what it was before. And when you are in consumer and retail or other industries and you want to scale faster, it's all about the alignment of incentives. As Charlie Munger said before, show me the incentive and I'll show you the outcome. Thank you very much.